Welcome to our latest deep dive into innovative business strategies. Today, we're unpacking a groundbreaking approach called client-financed acquisition, or CFA, which has revolutionized how businesses can achieve rapid growth without relying on external investments or substantial seed capital. If you've ever wondered how to bootstrap your business to success or make every dollar work harder for you, this video will reveal the secrets to using client revenues to fuel your business expansion from day one. Stick around to discover how to turn your customers into your greatest investors and propel your business to new heights. Number 1. Rethinking Capital. Traditional business models often rely on external investments or significant initial capital, expecting a long road to profitability. However, by altering the approach to utilize client-generated funds, businesses can achieve profitability faster and with less stress. This method not only changes the financial dynamics, but also introduces a mindset shift towards more sustainable business practices. Client-financed acquisition is a strategy where a business uses its initial sales to cover all marketing and acquisition costs. This model allows a business to scale rapidly by reinvesting profits from early sales back into customer acquisition. For example, if a tech startup uses this model, they could fund their software development by pre-selling licenses or subscriptions before the official launch. Similarly, a fitness chain might use memberships sold before opening a new gym location to finance the gym setup and marketing. A startup initially relying on high-cost marketing strategies switches to more cost-effective grassroots marketing methods that engage customers directly, reducing upfront expenses and leveraging customer payments for further growth. A service-based business might use initial service fees collected to fund further expansion, such as opening new locations or extending service offerings. Number 2. Client-financed acquisition explained. Client-financed acquisition revolves around the concept of using the revenue generated from new clients to cover the costs associated with acquiring them. This approach ensures that every new customer helps to self-fund the marketing and operational costs needed to attract them, turning what is typically an expense into a profit center. Effective cash flow management is crucial under the CFA model. The aim is to ensure that the cash earned from clients in the first 30 days covers at least twice the combined costs of acquiring and fulfilling customer needs. A practical example would be a consulting firm that uses upfront payments from clients to fund operations and payroll without needing a line of credit. Another scenario could involve a product-based business, such as a specialty tea shop, using the proceeds from initial pre-orders to cover the cost of their first production run. A software company funds its development and scaling efforts through the advance payments received from its annual subscriptions without needing external funding. Number 3. The CFA equation. The core of client-financed acquisition lies in the formula that dictates operational success. The revenue from the client within the first 30 days must be at least twice the combined cost of acquiring and fulfilling the needs of that client. This ensures that the business maintains a positive cash flow and can reinvest in acquiring additional clients. The strategy emphasizes achieving a quick return on investment, ROI, by ensuring that the revenue from customer acquisitions swiftly covers and exceeds the costs associated with those acquisitions. For instance, an e-commerce store might use targeted flash sales to generate quick revenue that funds further marketing campaigns. Alternatively, a mobile app could offer in-app purchases that provide immediate cash flow to reinvest in attracting more users. An online retailer uses the first purchase of new customers to cover the costs of digital ads, effectively making the marketing effort self-sustaining. Number 4. Implementing CFA for scalability. Implementing client-financed acquisition requires meticulous planning and execution, but can dramatically reduce the reliance on external funding. By ensuring that each client's revenue contribution exceeds their acquisition and service delivery costs, businesses can scale rapidly without traditional financial constraints. Keeping acquisition and fulfillment costs low is essential to maintain profitability. This could involve negotiating better rates with suppliers or optimizing its spend to lower the cost per acquisition. An example is a clothing retailer who uses dropshipping to reduce inventory costs, thus lowering the overall fulfillment expenses. Another example is a digital marketing agency that streamlines its service offerings to focus on high ROI activities like email marketing and social media ads, reducing labor and overhead costs while maximizing client impact. A digital marketing agency implements a referral program where the referral incentives are fully covered by the initial fees paid by the new clients brought in through the program. A B2B company offers early payment discounts to clients who pay their invoices within the first 30 days, accelerating cash flow to fund further client acquisition. In conclusion, client-financed acquisition presents a powerful model for businesses aiming to scale without significant external investments. By understanding and applying this model, entrepreneurs can fundamentally transform their approach to business growth, leveraging their existing client base to fuel expansion. This strategy not only ensures financial health, but also fosters a proactive culture of reinvestment and innovation within the business. Let us know in the comments what your most effective strategy has been, and we'll see you in the next video.